Welcome back, everyone. Take a seat because tonight we're going to talk about the story nobody wanted to tell, the one that's been quietly building behind all those optimistic headlines. For months, the message was simple. The U.S. economy is strong. The recession fears were overblown. But something changed. And if you look beyond the press releases, beyond the talking points, you can feel it. The U.S. recession isn't coming. It's already here, not in theory, not in forecasts, but in the one place that reveals everything, the labor market. Hiring has fallen to its lowest level since 2008. Job openings have dropped by nearly a third from their post-pandemic peak. And for the first time in years, private sector jobs actually shrank. 32,000 gone in a single month. That's not a slowdown. That's a turning point. Yet somehow the stock market keeps climbing. Wall Street is celebrating record profits, while Main Street is quietly holding its breath. The headlines say growth. The data says recession. And the truth? The truth sits somewhere in between, in a silence that feels a lot like denial. Because this isn't the dramatic collapse of 2008. This is something colder, quieter. A slow-motion decline that everyone's pretending not to see. A recession you can't measure in panic, but in pauses. In the job offers that never came. The small businesses that stopped hiring. The anxiety that creeps into conversations about rent, groceries, and mortgages. So tonight, let's look beyond the noise. Let's strip away the illusion of strength and ask the question that no one in Washington wants to answer. How can an economy still be growing when the people who make it run are standing still? Because this, right here, is the moment the mirage begins to fade. And what's left behind will tell us everything about where America is heading next. Let's start with the facts. Not opinions, not spin, the cold numbers that most networks barely mention anymore. According to the ADP employment report, the U.S. lost 32,000 private sector jobs in September. That might sound small at first glance, but it marks the first negative month-over-month job growth in years. It's the signal economists have been waiting for, the one that officially confirms what millions of Americans already felt months ago. The labor market has entered recession territory. The Bureau of Labor Statistics paints the same picture. The hiring rate in August fell to its lowest point since the 2008 to 2009 financial crisis. Think about that for a second. We're not talking about a cooling-off period or a minor correction. We've fallen all the way back to the darkest employment levels of the Great Recession. Even the private job data from Indeed shows the same downward spiral. Job postings have dropped roughly 30% from their pandemic-era highs, erasing nearly all the gains of the so-called recovery years. In plain English, America is hiring less, much less, than it has in over a decade. And this isn't just a single-sector problem. It's happening across industries, across states, and across income levels. The pulse of job creation, that steady rhythm that keeps the economy alive, is fading. The machine is still humming, but it's no longer moving forward. Economists have a name for this moment, a labor market recession. It's when growth stops without headlines, when pain spreads without panic. Because unlike 2008, there are no mass layoffs dominating the news cycle yet. Instead, we're watching a quieter collapse, businesses freezing hiring, scaling back hours, and letting attrition do the dirty work. This is why so many people are confused. They look around and say, wait, where's the crash? Where are the layoffs? But recessions don't always explode. Sometimes they just drift in like fog, slow, inevitable. And once it's settled, you realize visibility is gone. Every month, fewer Americans are finding new jobs. Every quarter, more companies are announcing hiring pauses. And the most telling detail: the average duration of unemployment. The time it takes to find a new job is quietly lengthening again. It's the same early pattern we saw in 2007 before the headlines caught up. So yes, the data confirms it. The recession isn't a fear, it's a fact. It's just being hidden behind temporary illusions, a rising stock market, a few optimistic GDP forecasts, and a government report that's conveniently been delayed because of a shutdown that furloughed BLS workers. That's right. The one dataset we rely on to measure jobs, the Jobs Friday report, was postponed. And instead, the public is left to trust private data, the same data that the majority of Americans now say they believe more than their own government. A recent poll found 79% of people think official job numbers are manipulated, inflated to appear stronger than reality. Maybe they're not wrong. Maybe the numbers have become a performance, one last illusion of stability in a system that's already cracking. Because when the people stop believing the data, it's not just the economy that's in recession, it's confidence itself. Here's where things stop making sense. By almost every traditional measure, the US economy should be slowing, but it isn't. At least, not on paper. The GDP is still growing. 3% to 3.5% mid last quarter. Corporate earnings are up 10 to 12% year over year. The S&P 500 is flirting with record highs. And yet, the real economy, the one most Americans actually live in, is quietly shrinking. It's a contradiction that defies logic. How can a country lose jobs and still grow? How can wealth rise when the foundation beneath it, labor, is eroding? The answer, as always, lies in where that growth is coming from and who it's for. Today's so-called boom isn't being built on new factories or small businesses. It's being driven by artificial intelligence, financial engineering, and corporate cost-cutting. Wall Street has found a way to grow profits without growing people. Major corporations have learned that they don't need to hire more workers to make more money. All they need to do is automate, consolidate, and let algorithms do what used to take human effort. And the result is an economy that looks prosperous from a distance, but feels hollow up close. We're witnessing the rise of the pokey post-worker recovery. Productivity is rising, but pay isn't. Profits are soaring, but participation isn't. For the first time in modern U.S. history, the economy is expanding without adding jobs. That's not progress, that's detachment. The unemployment rate still looks low, about 4.3%, up from 3.4% 2 years ago, but still near a 50-year record. Politicians point to that number like a trophy, saying, "See, we're doing fine." But that number hides more than it reveals, because companies aren't firing en masse, they've simply stopped hiring. The layoffs rate is just 1.1%, half of what it was in 2009. But when people leave, their jobs don't get filled. The office chair stays empty. The workload gets spread thinner. And slowly, the economy begins to stall, not with a crash, but with exhaustion. It's like watching a car run on fumes, still moving, still pretending to be fine, until the engine finally gives out. So when you see the stock market celebrate another all-time high, remember what it's celebrating. Efficiency, not humanity. It's cheering for profits that came from replacing workers with code, from extracting more out of fewer people, from a labor force that's being quietly written out of its own success story. We've entered a strange new phase of capitalism, one where growth no longer means opportunity, where an economic expansion can happen without the people expanding with it. And if you think that can last forever, ask yourself, what happens to a society where the rewards of growth are divorced from the reality of work? Because that, right there, is the paradox that defines this moment. We built a system that no longer needs the worker, and we're calling it prosperity. Every recession tells a story, not just of decline, but of imbalance. Because even in downturns, someone always wins. The only question is who? This time, the dividing line is clearer than ever. While much of the economy slows to a crawl, A few sectors are booming, and they reveal everything about what America truly values right now. Look at healthcare. Therapists up 85% in job postings since before the pandemic. Physicians and surgeons up 84%. Civil engineering, nursing, elder care, all showing extraordinary demand. In total, healthcare-related jobs are up in 38% and in postings compared to 2019. Why? Because sickness doesn't slow in recessions. Because an aging population still needs care, even when everything else freezes. Because in a society where the economy breaks people down, there will always be work for those who help patch them back together. But outside that safety net of essential work, it's a different story. Software development down at 37% all. Media and communications down 36%. Scientific research down 31%. Marketing down 23%. Whole sectors that once defined the middle class are contracting fast. And the geography of this collapse tells its own tale. Cities like Cleveland, Pittsburgh, and Boston, places built around hospitals, universities, and stable infrastructure, are weathering the storm better than most. But out west, in California, the cracks are widening, especially in Los Angeles, where the entertainment economy, once a symbol of American creativity, has become a case study in economic fragility. Sound stages that used to run at 90% occupancy now sit at 62%. Projects are on hold, crews are out of work. The post-strike recovery everyone expected never came. And the city that built the dream machine is suddenly waking up to the reality that it may have overproduced fantasy and underbuilt stability. You can feel it in the silence of those massive studios, in the "for lease" signs outside once bustling creative offices, in the Uber drivers who used to edit films, the waiters who once worked production sets. It's the sound of an industry and a city gasping for air. And that's the deeper truth about this labor market recession. It isn't hitting everyone equally. It's selectively punishing sectors that rely on innovation, risk, or media, the very engines that once gave the US its competitive edge. Meanwhile, the safest jobs are the ones tied to the body, not the mind, to care, not creativity. We're watching an inversion of value. The economy no longer rewards imagination. It rewards endurance. The jobs that heal people are thriving, while the jobs that express them are vanishing. And as that divide deepens, America starts to feel like two economies stacked on top of each other, one practical, essential, overworked, and surviving, the other creative, aspirational, and quietly collapsing. But the most painful part? Both are connected. Because when creative and tech jobs vanish, cities like Los Angeles lose their lifeblood. And what follows next is even harder to ignore. The collapse of local housing markets, the exodus of talent, and the erosion of what once made those places vibrant. The recession isn't just economic anymore. It's cultural, it's emotional, and it's slowly reshaping the map of who thrives in America and who gets left behind. If you really want to know where the economy stands, stop looking at the stock market. Look at the neighborhoods. Look at the for sale signs that stay up longer each month. Look at the families hesitating to make the biggest purchase of their lives. Because when jobs disappear, homes always follow. Right now, homebuyer demand is sitting near a 30-year low. And it's not just about affordability anymore. It's about fear. Fear of losing work. Fear of not finding new work. Fear that this stability might not be real. For the past 2 years, the story went like this. Don't worry about a housing crash. Everyone has low mortgage rates. No one's forced to sell. But that story is already unraveling. The share of Americans with sub-3% mortgages has fallen from 25% to 20%. Meanwhile, the number of people stuck with 6% or higher rates has nearly tripled, from 7% to 20%. And by the end of 2025, most U.S. mortgage holders will actually be on those higher rates, not the lower ones. That changes everything. Because when rates rise, people stop buying. And when people stop buying, inventory starts to build. And when inventory builds, prices fall, no matter how many talking heads say otherwise. The data already shows the cracks. In markets like Atlanta, home values have dropped around 3% over the past year, with some counties down nearly 8%. Inventory there has surged 17% to 52% year over year. That's not a soft landing. That's the sound of demand breaking under its own weight. And here's the brutal truth. The average monthly payment to buy a home at current rates, about $2,750, is now 40% higher than renting the same place or staying put with an older mortgage. Renters pay around $2,000. Existing owners pay roughly $1,900. So why would anyone take the leap? The answer is simple. They're not. First-time buyers have vanished, and even investors, once the wildcards who fueled bidding wars, are stepping back, waiting for deeper discounts. Yet hidden in all this instability, there's a strange opportunity. Those with stable jobs and strong cash positions are watching this unfold like hawks, because they know what always comes next: forced sales, distressed listings, and the quiet return of bargains, the kind of opportunities that only exist when others can't afford to see them. That's how recessions redistribute wealth, not by design but by gravity. The strong buy what the struggling can no longer hold, and in the process, the dream of homeownership gets a little smaller, a little farther away for everyone else. But there's another danger here, one that can't be measured in prices or interest rates. It's the emotional exhaustion of a population that's done everything right and still feels like it's falling behind. Families locked in their homes because they can't afford to move. Young couples postponing children because they can't secure a mortgage. Retirees watching their savings melt away under property taxes and insurance hikes. This isn't just a housing correction. It's a psychological one. The American dream used to be a home with a yard and a little stability. Now it's just staying in place, holding on long enough to outlast the next wave. So when analysts say housing is stable, ask yourself, stable for who? Because if you're sitting on a 6.5% mortgage, paying $800 more a month than you were 2 years ago, stable feels a lot like slow-motion collapse. And if you're waiting for the crash to be televised, it won't be. It's already happening. One quiet price reduction sign at a time. Every map tells a story. And if you look closely at America's economic map right now, it doesn't show one nation. It shows fractures, different realities depending on where you stand. In the Southeast, some places are still defying gravity. Cities like Charleston, South Carolina are leading in job growth. Construction cranes still dot the skyline. Restaurants stay full. Life feels normal, for now. But drive a few hundred miles in any direction, and the illusion fades. In Las Vegas, job growth has turned negative. In San Francisco, layoffs and high office vacancies are rewriting the city's story. And in Portland, Oregon, the job market is contracting faster than anywhere else in the Pacific Northwest. These aren't isolated numbers. They're symptoms of a deeper transformation, one where economic resilience now depends entirely on what kind of economy you built before the storm hit. States anchored in healthcare, logistics, and infrastructure, like South Carolina, Ohio, and Pennsylvania, still have muscle memory from the industrial era. They move slower, but they endure longer. Meanwhile, states that tied their fate to tech, media, and speculative real estate are learning how quickly the wind can change. Look at Florida and Texas, two of the fastest-growing states during the pandemic. For years, they were magnets for migration, families, retirees, investors. But the tide is shifting. Housing inventory in Tennessee is now 53% above its long-term average. Colorado, Texas, and Florida all sit around 49% to 51% above average. In other words, more homes are sitting unsold, and more sellers are lowering prices. When inventory spikes like that, it's not just about interest rates. It's about confidence. People sell when they can't see stability ahead, and this time the warning lights are flashing across the map. Atlanta, down 3% in home values overall, nearly 8% in some counties. Colorado, Arizona, Texas, and Florida are all projected to see 5 to 6% price drops over the next 12 months. In the housing world, that's massive. 5% doesn't sound like much until you realize it erases hundreds of billions in household wealth. Meanwhile, the Midwest and Northeast, regions often dismissed as boring markets, are suddenly the most stable in the country. In Illinois, the average home still sells in 38 days. In 30, New Jersey, 40 days. Compare that to Florida, where the average listing now lingers for 87 days, and values are already down 5.1%. It's not one housing market anymore. It's two Americas sharing one flag, one overheated, the other quietly steady, one built on speculation, the other on endurance. And as these patterns harden, they're reshaping migration itself. People are no longer chasing the hottest states, they're chasing stability. Families that once dreamed of Sunbelt suburbs are now eyeing the Midwest. Investors who once chased fast returns are shifting toward long-term safety. Because the truth is, recessions don't destroy wealth, they relocate it. And in this one, it's moving north, inland, and into the hands of those who still have patience. But here's the part no one on television wants to admit. Geography is just the surface. What really divides America now isn't land, it's certainty. Some people still believe in the system. Others have already checked out. And that's not just an economic split, it's a psychological one. The recession isn't just hitting harder in some places, it's believed differently depending on where you live. In the Midwest, people call it normal. On the coasts, they call it collapse. But the feeling underneath is the same, a quiet dread that the future isn't what it used to be. Let's be honest, recessions don't just break economies, they expose them. They show you what was already fragile, already stretched, already quietly unsustainable. And nothing reveals that fragility more clearly than wages. Because if jobs are the engine of the economy, wages are the fuel. And right now, that tank is running dry. After peaking at 9.4% growth in 2022, wage increases have fallen all the way down to 2.6% year over year, less than before the pandemic even began. That means paychecks are rising slower than inflation again. And when the cost of living grows faster than your income, it doesn't matter how many times the government says the economy is strong, you feel weaker. This slowdown isn't just statistical, it's psychological. Because people don't measure recovery in percentages. They measure it in groceries, rent, and gas. And for millions of working Americans, those costs are eating through every dollar they make. That's why home buyer confidence has cratered, not just because of mortgage rates, but because of exhaustion. Who wants to commit to a 30-year loan when your paycheck doesn't even stretch 30 days? Even the housing industry knows it. Builders are now resorting to desperate tactics just to move inventory. In places like Cape Coral, Florida, they're offering $50,000 discounts and special 30-year 3.99% FHA loans to lure buyers back. But look closer. Those are temporary teasers, a short-term fix in a long-term slowdown, because a discount only means something when people still believe in the product. And what's being sold right now, this idea of a stable, prosperous, upward-moving America, feels harder to believe each month. The truth is, the wage problem isn't new. It's the slow-motion result of decades of policies that valued efficiency over people, automation over jobs, shareholders over citizens. We built an economy where productivity could rise while pay stood still, and now we're living in the consequences of that choice. You can't build prosperity on paychecks that don't move. You can't restore confidence when people feel punished for working hard. And you can't revive the housing market when the average worker's raise barely covers the cost of 1 week's groceries. That's why recovery won't come easy this time, because recovery isn't about GDP. It's about dignity. It's about believing that effort still leads to stability. And when that link breaks, when people start feeling like the system only rewards speculation and inheritance, that's when societies begin to drift. Not just economically, but morally. So yes, wage growth is slowing. But what's really slowing is faith. Faith in the idea that this system can still deliver for the people who keep it running. We can measure everything else, jobs, rates, prices, but that kind of erosion doesn't show up in charts. It shows up in silence, in the growing number of people who've stopped expecting things to get better. And that silence, more than any number, is the real sign of recession. If this recession has taught us anything, it's that not all assets are created equal. Some lose value fast, others quietly hold it. And understanding the difference is what separates those who survive downturns from those who rebuild after them. Let's strip this down to something simple: land versus structure. The walls, the roofs, the drywall, those all decay. What endures is the ground beneath them, because that's what people are really buying. Not the home, but the location, the access, the permanence. When you buy a property, what appreciates over time isn't the wood. It's the world around it. It's the land, the infrastructure, the migration patterns, the human flow that decides which towns grow and which fade. That's why, in the long run, places like Dallas and Orlando are still scoring high on what analysts call the long-term growth score, a metric that weighs demographic health, affordability, and future potential. They're not immune to the recession, but they're structurally built for resilience. Their populations are expanding, industries diversifying, and their costs, at least for now, remain manageable. Contrast that with the speculative markets that boomed during the pandemic, the ones that sold lifestyle before logic. Those are the first to crack because they were never built on foundation. They were built on hype. You can always rebuild a house, but you can't rebuild demand where it's disappeared. And this is where the lesson comes full circle. Recessions don't just destroy wealth, they reveal its roots. They show you who owns land and who only rents the illusion of it. They separate investment from speculation and security from leverage. But there's something deeper underneath all of this, a truth we don't talk about enough, that in America, wealth has always been tied to the ground, not to currency, not even to corporations, but to ownership. To the idea that you can stake a claim, hold it, and pass it down. That's why housing collapses hit so hard. They don't just erase numbers, they erase belief. Belief in the system, belief in fairness, belief in the simple promise that if you work and save, you'll have something to show for it. And when that belief fades, so does everything else. Consumer confidence, entrepreneurship, even civic trust. So yes, some markets will recover faster. Yes, some regions will rise again, but what's being tested right now isn't geography, it's memory, our collective memory of what wealth used to mean. Because somewhere along the way, we started trading ownership for optimism, and now the optimism is running out. So here we are, in the middle of a recession that no one wanted to name. No market crash, no breaking headlines, no dramatic collapse, just a slow unraveling. Quiet, steady, and painfully obvious to anyone willing to look. Jobs are disappearing without layoffs. Homes are losing value without foreclosures. Wages are shrinking without protests. It's as if the entire system decided to go into decline politely, without disturbing the peace. But make no mistake, this is a turning point, because behind the numbers and the forecasts, there's a deeper truth. We built this recession ourselves. We built it when we turned growth into a substitute for fairness, when we celebrated rising stock prices instead of rising paychecks, when we told ourselves that automation would free workers but used it instead to erase them. And when we began measuring success not by how many people prospered, but by how many investors smiled, that's why this downturn feels different. Because it isn't just economic, it's moral. It's the price of pretending that a society can stay healthy while its people slowly lose ground.